Here's Jonathan Golub of Credit Suisse, the chief US equity strategist. John, have we seen the full capitulation yet, or do you think we still underestimate, underappreciate certain parts of the recovery still to come, at least in your mind?
Yeah, John, you're 100% right. We have not even begun the process of reopening. I mean, you're talking about people celebrating come the 4th of July. And while a lot of Americans have gotten vaccinated, there's more to go there. We just had the $900 billion hit, and now we have $1.9 trillion coming down the pike. So the real economic acceleration is something we're going to see further out. And here's the key. The market is underestimating the power of this reopening.
Well, let's talk about where and how and what part of this market. And John, I know from your research, being familiar with it over the last couple of weeks, the phrase you used is explosive earnings. Can you walk me through what you're expecting and what you see in terms of market expectations?
Yeah, so, I mean, the consensus view is that you're going to actually have 22% upside in earnings. And we think that you're going to see something that will be closer to 30% year-over-year upside to earnings. The key, though, is where it's going to happen in the market. It's going to happen in value stocks. So this is really weird. Value stocks are going to have faster earnings growth this year than growth stocks, between maybe 7 to 10% faster. And that's going to be a surprise. So you were talking all before about FANGs, the FANG stocks and big tech names, but that's not where the juice is going to be this year. It's going to be in machinery names and industrial names and mining companies and chemical companies and energy companies and banks. It's going to be an old economy stuff that we've been told not to fall in love with over the last decade. That's where the excitement is going to be over the next 6 to 9 months.
And that takes us through 21, John. And I guess then we have to start thinking about 22 pretty soon. Are you thinking about that yet, or is it still too early? Because I've been reflecting on how quickly things have been moving over the last 12 months, and it just feels like we get through the early part of the cycle like that, click of the fingers. When do you start thinking about 22?
Well, I mean, John, there's always risks looking out further. So the first thing is, as I see 1.9 trillion, and then there was a comment that was made in your political segment before about infrastructure builds and what we may do even after this. There's a risk that we're just going to overheat this thing. Wall Street is very concerned about inflationary risks, and the fact that the economy is going to grow so fast just sets itself up. So there's a possibility that you have a problem digesting all this growth, probably early next year, but maybe as early as the beginning or towards the end of this year. Remember, we're also going to be looking at the potential for higher taxes. And when we had a weak economy, nobody wanted to think about how do we pay for this stuff. But as things get back on course, from an economic perspective, this tax discussion is going to come back into the fray. So I think that we have, 6 to 9 months of really unfettered upside, but then there will be some bumps in that road that the market's going to focus on. The key here, though, is, and this is a piece of advice I got from one of the most successful hedge fund managers: don't be too smart. Don't worry about what's going to happen in a year or two from now. If the music is playing, party on, enjoy it. And if you try to discount the problems that you're going to see in 2022 or 2023, you're going to miss the upside that's being handed to you right now.
And John, that piece of advice is so important, and that's why journalists would make terrible traders, because they're always poking holes in absolutely everything. There's always a reason to be short pretty much everything at any given time. John, sticking with it is hard. People find it difficult, and I think people want to be nimble. They want to anticipate the next problem. What's your advice to clients when you pitch that to them? Just stick with it. Stick with it. What do they say back?
Well, first of all, John, I think it's really important that we have yardsticks or signposts or things to check whether or not this is gotten, we've gotten too far. First of all, markets that have gone up a lot, that by itself is not reason to not buy them. However, if the stock market has gotten expensive, that's an issue. If you look at these cyclical sectors that I was talking about, energy, materials, financials, industrial names, they're actually very depressed in valuations because the tech names had been leading by so much, not only going into the pandemic, but even in the first 3, 4, 6 months after the pandemic hit. So this trade right now is actually very inexpensive. Second thing is the earnings. Right now, we're expecting much better earnings for value stocks and for these cyclical companies than we are for these FANG growth winners. That's not going to stay that way forever. Ultimately, you're going to have this thing reverse back, but it's probably not going to be until the middle of next year. The other thing is we're seeing upside surprises. Companies are coming in with much better results, but where's that happening? The upside surprises are happening in the cyclicals. When we actually start to see that the FANG names are surprising bigger again, which is what's been the case for a decade, that's something. So I guess the key is make a list, put it on your desk, and if you see certain things shifting back, then you know the trade is over. But simply the stock market being up, that's not enough.